10x in the next 10 years. That is a compounded annual growth of 36%. 36% growth for the next 10 years. So I still think there's a long runway for these technology companies. Now, technology stocks, or you can just buy the ETF. It's up to you. Okay, so if you're just looking at the ETF, you can look at the XLK, which is the technology ETF, or simply look at the Triple Q, which is the NASDAQ 100 ETF, and call it a day. Okay, if you want to look at specific stocks, then these are some of the ones that I'm looking at. Now, first of all, when it comes to AI, which I think will be the big growth driver the next 10, 15 years, right? There are three parts of AI. First will be cloud computing companies. Almost every business on planet Earth will have to use a cloud computing service. Okay? So Amazon, Microsoft, and Google combined have a 65% global market share. So to me personally, these three stocks, this is not advice for you to buy. I'm not giving you financial advice. I'm just telling you, in my opinion, these three stocks are a must in my portfolio and will continue to be in my portfolio. Okay. Number two are AI accelerator semiconductors. So these are semiconductors that are required to run AI. And these are the GPUs that are supplied by NVIDIA with a 90% market share, and AMD doesn't have a 10% market share, my bad. AMD has a 4% market share. And semiconductor for AI has a 24% CAGR in the next 10 years. Next will be AI software. So AI software, there are many parts to it, but I am focused on cyber security. Again, you could just look at the ETF. There are many of them. I think the best one is IHAK. IHAK is a cybersecurity ETF that invests in a basket of many cybersecurity companies. All right. My two favorites are Fortinet, FTNT, and Palo Alto, PANW. Although PANW, I really want to buy this stock, but right now it's too expensive. This is get cheap to add. But Fortinet, I've been buying it, and I think it's not expensive yet, in my opinion. Okay. Next, enterprise software. Enterprise software, I think there are two big players in AI enterprise software. Number one is Palantir, which I own. And the other one is UiPath. But UiPath is a bit risky because it is not yet profitable. So it's more speculative. So for UiPath, I don't own it, but I'm looking to get in as a trade, not so much as an investment. It's more of a trade, because if it's something that is not profitable, I don't feel comfortable holding as an investment. I'll just trade it using options or just enter with a stop loss, right? But again, I'm waiting for the right point to enter based on the chart patterns. So all this is what we teach in the course, looking at the chart patterns, technical analysis to optimize the entry of these companies. Okay. How about CrowdStrike? CrowdStrike is also a great stock, but it's still losing money, and it's very expensive. It is way overpriced. All right. That's why I prefer Fortinet and Palo Alto that are consistently profitable already, right? Now, here's an interesting thing that's happening. How many of you know that globally we're having a labor shortage in the world? Not in the not in the developing countries, but in the developed markets like UK, Europe, US, even Singapore. You guys know that we're having a global labor shortage. Yes, we are. So there are more people, or rather, there's more job openings than people looking for jobs. So there's a shortage of labor. And you can see from this chart over here, that the global excess supply of labor is gone. For the first time since 1973, we're having a global labor shortage. Now, let me ask you this question. Who will benefit from this? Which companies will benefit from a labor shortage? Technology companies, right? Because if you are a business and you don't have enough staff, you are forced to turn to technology in order to replace your lack of staff, right? So look at this chart over here, and this is credit to, and you can see historically there was a labor shortage from 1948 to 1967, 1991 to 1999, and now 2015 to 2047. Up to 2047, that's a projection. Now, every time there was a labor shortage, technology stocks went parabolic. You see, these are the tech stocks went up. Tech stocks went up. And right now we are here. And if this trend continues, you can expect that technology stocks will ultimately become 50% of the S&P 500. Okay? So that's the first sector, technology. Number two, financials and healthcare. So why do I think financials and healthcare could do well this year? Because they did very badly last year. Okay? Financials and healthcare did very bad. They were in an earnings recession. Check this out. Can you see financials? Can you see healthcare? In 2023, their earnings was negative. But in 2024, financials is poised to grow at 6% earnings growth, and healthcare at 17% earnings growth. All right? So now, again, for financials, if you just want to look at the ETF, you can look at the XLF. And for healthcare, you can look at the XLV. If you want to buy, if you want to look at specific stocks in finance and healthcare, hold on. I'll talk about my favorites in a while. Okay? Motley Crue, called Motley Crue. In Singapore, forget it. Singapore is a waste of time. Right? Now, Singapore stocks, I say it's a waste of time based on capital gain, right? In my opinion, I could be wrong, but if you want to grow your money, forget Singapore, right? Singapore is not to grow your money, right? Singapore stocks is to just maintain your wealth. So the three Singapore banks, I own the three Singapore banks just to get dividends, but I don't expect much capital gain to come from there, right? Next are industrials. Industrials should outperform because of the manufacturing activity bottoming and starting to grow again, and also the potential recovery in Europe. And if China recovers, it will bode well for industrial companies. Now, personally, I don't like to own industrial companies because industrial companies tend to be very cyclical, so I don't like to own them. So if I do buy industrials, it'll just be for short-term trade. And I would probably just buy the ETF, which is the XLI, once I see a good entry point on the charts. Okay. Next, small caps. So for small caps, again, I'm not looking to buy individual companies. I bought the VBK. VBK is the small cap growth ETF. I already bought it already, but I may buy a bit more depending on the chart pattern, right? So let me share something interesting with all of you. Historically, small companies used to outperform big companies many years ago because Small companies are small, they have more growth potential. Whereas big companies are already very big. So how much more can they grow, right? Now, this was historically. But in today's world, what I realize is that it's very hard for small companies to beat big companies. Because now we are in a world where winner takes all. Winner takes all. Where in many industries you find that the big companies are like a monopoly, where they kill all the small players. And any small company that attempts to grow big will be taken over or killed by the big player. You follow what I'm saying? And that's why in my portfolio, I don't bother buying any small companies. I just buy the giants. I buy the Goliath, like your Amazon and your Microsoft, okay? Now, if you look at this chart, this here is the S&P 500, which are the big companies. And the one in orange is the IWM, which is a small cap ETF. So you can see that historically, the small caps was keeping pace with the large caps. But the divergence happened during COVID. Can you see that COVID was the first time that the small cap dropped more than the big cap. And then during the recovery, the small cap couldn't beat the big cap. Why? Why? Because during COVID, would you agree that small companies suffer the most during COVID? You agree that small companies are the hardest hit because they don't have the financial muscle. They don't have the moat strong enough. That's why they couldn't recover. And then in 2022, when interest rates went up so fast, the small caps, they don't have much cash. So when interest rates go up very fast, these small companies suffer the most because they can't raise money easily anymore. Their debt is causing too much interest expense. Okay? If interest rates continue to go down, then I think that the small caps will have a chance to at least rebound back. Maybe not beat the large caps, but at least have some recovery. And that's why I bought into the small cap ETF VBK to catch this rebound in small caps, right? But it's not something I will hold for very long. Once it rebounds like maybe 30-40%, I would just get out. Because long term, I don't think small companies will do well as compared to large companies. Yeah. Useful so far, guys? Okay, so finally, well, not finally, but almost towards the end. After this, I'll do a Q&A, and I'll also share with you the offer that we have for my masterclass of investing, my investing masterclass that you may want to enroll in. 4 days live with me. Everything you need to know to be a super investor, right? Okay. Now, of course, there are many great companies, and I own many stocks, but I would say that among all of them, these are the 8 that I think are high quality, that are still of reasonably good value. Okay? So first, in the technology category, Amazon. Let me tell you why as you guys know, I've been very bullish on Amazon for the last few years already, right? But to me, I think this year, I think Amazon will be the best performer among all of them. Again, I could be wrong. I could be wrong, right? It's just my guess, okay? Why? Now, first of all, Amazon, people think it's just an e-commerce business. It is not. Amazon has got 5 businesses into one, okay? First is the e-commerce business. That one we all know. Second is their advertising business, right? Now, do you know that currently, Amazon's advertising business is bigger than YouTube? It is now exceeded YouTube. Now, not only that, their third business is in Amazon Prime Videos. Give me a second, please. Yeah, is in Amazon Prime Videos. If I'm not wrong, they have got 200 Amazon Prime members, which I'm one of them in Singapore. But in the US, 200 Amazon Prime members. And right now, when you are Amazon Prime member, you get all the videos for free. But this year, for the first time, Amazon will be putting advertisements on their Prime videos. Do you know what that means? That means they will suddenly have a significant new revenue stream. Netflix, if I'm not wrong, Netflix has 80 million subscribers, right? 80 million. So simply by monetizing their Amazon Prime videos overnight, Amazon will be bigger than Netflix. Overnight, Amazon will have 200 million Prime Video members watching advertisements, double of Netflix. Okay, that's number 3. Number 4, Amazon is in a logistics business. And their logistics business has overtaken FedEx and UPS. All right? Their 5th business is cloud computing. And they're the market leader in cloud computing. In fact, Netflix themselves, their whole business is built on Amazon's AWS. So Amazon has purposely not want to show their profits in the last few years. They have artificially depressed their profits for all kinds of reasons. But I think this is the year where Amazon is going to show their hand. They are going to finally show their profits because they are at the end of their CapEx cycle and they are beginning to cut costs to show profits. And I think once they show their profits, they could easily double to triple their profits and free cash flow. And that's when you will see this giant wake up. Again, this is just my opinion. I could be wrong, but I'm putting my money where my mouth is. My second biggest position in my portfolio is Amazon. Okay? Now, next is Google, Alphabet. Now, we all know Alphabet, right? Meta Platforms. Fortinet. Fortinet is, if I'm not wrong, the second biggest player in cybersecurity. Okay. Now, in a short while, I'll show you the charts and I'll show you my intrinsic value, right? Because right now it's just what stocks. But remember, investing is not just knowing what stocks. It's knowing when to buy, when to sell, and how many shares to buy. Okay. I think financials will do well this year, but personally, I don't like to invest in US banks because banks are very cyclical and they are very low growth. And long run, the banks don't outperform the S&P 500. So for financials, I like payment technology providers like Visa, MasterCard, but I think the highest growth will come from ratings agencies like S&P Global. Okay, healthcare. I love healthcare. One of my favorite sectors because healthcare is both in a long-term growth trend because of the aging population in the world, plus healthcare is defensive. So if we do get a recession this year, if healthcare stocks should remain resilient in a recession. That's why I love healthcare, right? But for healthcare, I don't touch pharmaceutical stocks because most of them are very unpredictable. And the only one that is doing well is Eli Lilly and Novo Nordisk, but they're both very expensive. So I rather go for managed healthcare providers as well as medical devices companies. So my 3 favorites are United Health, Viva Systems, and MedPace. Right? So these are the 8 stocks I'm highlighting for this year. Right? So let me just show you some of them right now. Let's look at Amazon. So my intrinsic value for Amazon, now you guys know I calculate my intrinsic values using my intrinsic value calculator. So it's something that you have to learn. You have to learn the skill of how to value stocks. So you know what is it worth. Then you know if something is expensive or cheap. If not, you're always guessing. You cannot guess. It's all about numbers. So in the Wealth Academy investor masterclass, where again, I'll be spending 4 days with you guys live, right? We'll go into step-by-step detail about how to use all these calculators, right? Give me a second. Can you guys hear me? Sorry, give me a second. A bit of confusion over. Okay. Can you guys hear me now? Okay, great. Okay, where was I? Okay, yeah, so look at Amazon. So like I said, right, this is something that you're going to learn in the investment course, right? So right now, Amazon has an intrinsic value of $178. Right, 178. Right now the share price is 159. So at 159, it is still about 10% undervalued, right? Still 10% undervalued. So I think it's still selling at a pretty reasonable price. Okay. Now if you look at the charts, let me just bring up the charts right here. Okay, now it's taking some time to load. Damn. Okay, this happens. I'm sorry. Okay, never mind. Let me go to my alternative charts. Let me use TradingView. Okay, so right now, fundamentally, Amazon is undervalued, right? But if you look at the wave pattern, it is what? It's a wave up here, it's a wave down here, and it's a wave up here. So would I buy right here? Even though it is undervalued, would I buy right here? No, right? Because I like to buy only after a wave down to a support level, right? So I would only add somewhere here. Okay, so it's something that you want to watch. Once you have a list of stocks you want to buy, every day, take 5 minutes, look at the charts, and wait for the price to drop to a support level, and that's where you add. And again, if you subscribe to UIP, you get my daily notifications about when I'm buying, when I'm selling, and as well as all my option trades as well. Right? This is a 1-year daily chart. That's right. Okay. All right. Next, what's the next stock? It's Meta, right? Okay, let's look at Meta. So what's Meta's intrinsic value? Meta's intrinsic value, by the way, when I calculate the Meta, I'm using a very, very, very conservative growth rate, right? And because if I use the normal growth rate, I'll get like $600, which is very high, right? So I decided to be very undervalued. Very conservative. So my intrinsic value for Meta is $411. $411. Okay. And so right now it is still undervalued. Okay, still undervalued. But again, would I buy right now? Look at the chart. Would I buy right now? Wave up, wave down, wave up, wave down, wave up, wave down, wave up. Would I buy right now? No. Okay, again, I don't like to buy on a wave up. I wait for a wave down to support or here, and I'll start adding at support levels. Okay. Now, some of you, if you look at Meta, will say, but Adam, Meta is really up like, almost 200%. Don't you think it's too high? No. And I tell you why. If I zoom out, you can see what happened in 2022. We had this big drop, right? Can you see that? This was totally emotional mispricing. And although Meta is, it is just back to where? Back to where? It's just back to where it was. It is just back to where it was, right? So I won't be surprised if from here it can go up another 20 to 50%, because it had to first make up for this undeserved drop, right? This was an undeserved drop, okay? I know a lot of you guys have questions. Hold on, I have a Q&A coming up, so just hold your horses, okay? What's the next one? Next one is, now I won't run through all of them, okay? But I'll just show you Fortinet and a few more, okay? Fortinet is a cyber security company. So my intrinsic value for Fortinet is 90 bucks, right? 90 bucks is my intrinsic value. Right now it's at 66, still cheap, right? Still cheap, in my opinion, still cheap. And again, if you look at the charts, it has started to reverse, right? Wave up, wave down, wave up, wave down, wave up, wave down, wave up. Can you see that? So I wouldn't chase it here again. I wouldn't chase it. Wait for a wave down, right? Wave down to maybe about 61, where I would add only at 61. Now, I already bought a lot, okay? So I'm not buying more because I already bought. But I'm saying that if I didn't buy yet, then I would probably only add at about 61 after a bit of a wave down here. Next is a stock I just recently bought only. Just recently bought this. It is, hold on. It is Medpace. This is still in a buy zone, in my opinion. Intrinsic value is 307. So this is slightly undervalued, but I think it's a very high quality company. Clinical trials for pharmaceutical and biotech companies. Okay, they run the clinical trials for them, right? So again, look at that, wave up, wave down, wave up, wave down. Now it is beginning to wave up, right? So that's my intrinsic value, 307. So slightly undervalued, right? But the wave up continues, then it could go all the way up there. Viva Systems. This is another one which I think is a great company, but it has not outperformed as much as the other software companies yet. Okay, so my intrinsic value for Viva Systems is 261. So it is still undervalued in my opinion. Okay, and you can see right here, this was the downtrend. Then this is the new uptrend, right? Right, wave up, wave down, wave up, wave down. Now it's beginning to wave up here. Okay, so I already have a full position. I'm not buying more. I already bought a lot. Would I add here? Well, probably not. I'll probably wait for a bit of a pullback to about 190, 193 to add on Viva Systems. Right. Microsoft. Okay, I had a bit of a request on Microsoft. Microsoft is overvalued right now. So Microsoft, my intrinsic value is 376. Right now it's at 403. So it's slightly overpriced right now. So again, you can see wave up, wave down, wave up. Now it's going to wave up, right? I wouldn't add here. Again, I'm hoping February, March, we get a bit of pullback, drop, and, add at about 350. That would be a good area to add Microsoft if we get that pullback in February. Because I already have a lot of Microsoft. Okay, Google. Okay, you guys are asking me for everything. Fine. Google intrinsic value is 168, so Google is still undervalued. Oops, hold on. Google is still undervalued. But again, right now it's on a wave up, right? So would I add right now? Would I add wave up, wave down, wave up? I wouldn't add now. I'll wait for retracement to about 135 to add. Tesla, are you crazy, Keith? I'm just joking. I'm just teasing. Don't be angry, please. I'm just going to show you these 8 stocks. I'm not going to go beyond the 8, right? If not, we're going to take forever, okay? What have I not shown you yet out of the 8? United Health and SPGI. Okay. So United Health. Okay, United Health. Good news. Because its cousin Humana just reported some increase in medical costs. So United Health went down. Yeah, so United Health is looking attractive. Intrinsic value that I calculated is about 548. Right now it's about 500. So it is undervalued. And again, it just touched this support. Can you see? Beautiful. Look at that. Right? Toing, toing, and toing. So if this holds, it could shoot back up. Right? So United Health is one which, very nice, just came down. Would I buy crypto ETF? Are you insane? I'm just kidding. No, I won't. SPGI. SPGI, this is slightly overvalued. Intrinsic value 406. Right now it's at 446. Slightly overpriced. Again, wave up, wave down, wave up, wave down, wave up. I'll wait for a bit of a wave down to below, to at least 390 to add, right? But to me, I think these are the companies that I think are high quality and not crazily expensive yet, all right? Okay, I have to move on, guys. I know all of you are asking me about all kinds of stocks. I'm going to take forever if I run through all of them. Just give me about 2 minutes. I'm going to stop my screen sharing. Give me 2 minutes because I need to find something I want to show you. So just give me a while. Hold on. Oh. Sorry, give me a second.
Wait. The band no top, but that's still there.
Still there? Oh, resting.